Hello everyone, my name is Perseus and this will be the first video in this managerial accounting series. This will be an introduction and so will be the next two videos I am going to upload. Today we're going to talk about the definition of managerial accounting, also referred to as management accounting, the role of managerial accountants, the difference between managerial and financial accounting, and I will also provide some examples. The main sources I'll be using will be in Wikipedia, as well as this book over here. With that said, let's get into the definition. So, according to Wikipedia, managerial accounting is the practice of identifying, measuring, analyzing, interpreting, and communicating financial information to managers for the pursuit of an organization's goals. All right, so what would be financial information? Well, that could be, for example, rent, taxes, operating margin, sales revenue, and a lot of other things. And what would be non-financial information? Well, that could be, for example, employee satisfaction, accident rate, carbon footprint, and others. Now you might be wondering why I'm mentioning non-financial information, since it is not in the definition I just read out, and that is correct. It is not in the definition provided by Wikipedia. However, it is in the definition provided by this book, and I think I will agree with the book. I mean, if you think about it, all this can influence the performance of a company, and so these are things that management accountants are interested in. All right, so what are some things that management accountants do? Let's take a look at a few examples, all right? So let's start with the first bullet point: informing strategic decisions and formulating business strategy. And a management accountant, for example, might be interested in introducing a new product, but before they would have to analyze the market, observe whether there is a demand for that product, calculate the profit margins and the return on investment to see whether introducing that product is even makes sense. Then we have planning long, medium, and short-term operations. What would be a long-term operation? That would be, for example, a 5-year capital expenditure forecast for new equipment. A medium-term operation could be, for example, a 1-year production cost budget. And a short-term operation could be, for example, a monthly cash flow projection. Determining capital structure and funding the structure. Well, when a company wants to raise money, they have to decide whether they want to borrow money from the bank and get into debt, or whether they want to sell part of their equity to investors in exchange for capital. Of course, they can do both at the same time. Designing reward strategies for executives and shareholders. Well, a reward strategy could be, for example, an agreement that states that if executives grow revenue, they would be awarded with bonuses. And that, of course, benefits the shareholders because revenue grows and profits grow as well. They would get higher dividends. Informing operational decisions. If we think of a retail chain, such as one that sells shoes, the management accountant working there could take a look into the real-time sales, the historical sales data, inventory data, and other types of data to make pricing decisions. For example, they could identify some underperforming products and decide to lower their price so as to sell that stock and improve cash flow. Controlling operations and ensuring the efficient use of resources. If we think of a logistics company, a manager working in a logistics company could monitor fuel costs and vehicle maintenance expenses, and then see whether there are inefficiencies in route planning, and then if there are, optimize the route planning so as to save money on vehicle maintenance and fuel, thus lowering the cost of the operation and saving the company money. Then we have measuring and reporting financial and non-financial performance to management and other stakeholders. Well, if we think of a hospital, a management accountant working there could monitor patient wait times, cost per patient, and employee turnover. Then with that data, they could create a monthly report for the executives, highlighting issues, and eventually that could lead to changes being made in the organization that would improve the patient care quality and ultimately make for a more profitable business. Then we have implementing corporate governance procedures, risk management, and internal controls. Well, that could be, for example, the implementation of a fraud detection system that would ensure that the company's data, as well as the data of the customers, stay safe. Finally, exploring the potential for managerial and organizational value creation. Well, that could be, for example, the implementation of an AI chatbot that would lower labor costs and make and improve customer experience. Customers, instead of calling to get answers to simple questions, they could instead just chat with the bot. All right, so let's take a look at some questions management accountants often ask. Let's start with the first one. Who are our key customers, and what essential capability must we possess to remain competitive and provide value to them? Well, if we think of Toyota, they built flexible manufacturing plants that enabled them to use the same equipment to produce a variety of cars in response to changing customer tastes. What is the bargaining power of our customers? If we think of the Kellogg Company, they use their reputation to reduce the bargaining power of its customers and charge higher prices for its cereals. What is the bargaining power of our suppliers? Well, if we think of Dell Computers, they must consider the bargaining power of Intel and Microsoft. Intel sells to them microprocessors and Microsoft software. And of course, there aren't that many software out there. There's basically iOS, Linux, and Windows. So Dell doesn't really have the option of switching to another software, and that gives Microsoft a lot of power. And it's similar with Intel. So yes, and excuse me, I should have written this here. Yes, all right. What substitute products exist in the marketplace, and how do they compare to our, and for some reason this has been deleted, existing products what substitute products exist in the marketplace and how do they compare to our existing products. And I believe it's regarding pricing, costs, and quality. Well, if we think of Hewlett-Packard, they design and produce printers and computers, and they of course have to use different parts for those printers and computers, which they buy from suppliers. And the costs of these parts are always a consideration. So companies like HP are always in the lookout for cheaper parts from different suppliers. Of course, before they switch, they have to check to see if the quality is the same, whether the pricing is substantially lower, etc. Finally, will there be enough cash available to support the strategy, or will we need to secure additional funding? Well, when P&G decided to buy Gillette, they had to issue new debt and equity to fund this acquisition. And now let's get into the differences between financial accounting and management accounting. So, what is the purpose of information in management accounting? Well, the purpose of information is to assist managers in making decisions to achieve organizational objectives. So, keywords: assist managers in making decisions to achieve organizational objectives. Whereas in financial accounting, it is all about conveying information about the company's financial health to external parties, such as investors, banks, and regulators. Who are the primary users in management accounting? Well, the primary users in management accounting would of course be the management accountants in that company. In the financial accounting, again, the primary users are the investors, the banks, the regulators, and the suppliers. What is the focus and emphasis in management accounting? Well, management accounting is primarily forward-looking. We are concerned about the future more than we are about the past. We want to decrease costs in the future, prepare budgets, and forecast revenues. Whereas in financial accounting, we look at the past. We have a retrospective view of the organization. We look at the balance sheet, for example, ending in year 2024, or the income statement for the last quarter, etc. Measurement and reporting standards. Well, in management accounting, we do not have to adhere to any formal accounting standards. Companies just use metrics and tools that they believe are the best for them. Then, and in financial accounting, it is not like that. There are strict rules and regulations to which companies have to adhere. And so they have to follow those. Time span and report types. Well, in management accounting, we could create all sorts of reports ranging from 15 to 20 years to daily reports, etc. It just depends on the company and what are their needs. Whereas in financial accounting, since we have rules and regulations, those stipulate how often reports such as the balance sheet, income statement, cash flow, etc. should be produced, how often these should be produced. All right, so that is it for today. Thank you very much, and see you in the next video. And by the way, I'll try to upload this file as a PDF. I will leave a link in the description where you can download it. See you.